Money.
And we're back. It's Talkin Money with Jeff Tarbell.
Right. How you doing? I love reading the text during the break there. That's why I get up in the morning. Jeff, you actually had an El Camino. Admitting that is the equivalent of bragging about being the best kisser in your family. Well, being the best kisser in your family is different than having your dad say you're the best kisser in the family. So you got the joke wrong there. 339-1140, 1-800-920-1140. We're going to let our quiz question go a few more minutes while I take a couple calls here. So we did get one answer off the text line. We'll give that. And you don't have to answer all five. Just give me one. So we'll take this one winner from the 916. His guess, I'm guessing, for the worst five. Now, Kent's question was the percentage of occupancy, basically, at the stadium, if you will.
Correct.
Okay. So the bottom five, this person's bottom five was Oakland, Jacksonville, Cincinnati, Miami, and Cleveland. We don't need all five, but one of those was the worst, right?
Correct.
Okay, which one was it?
Cincinnati.
Okay, Cincinnati was the worst. I would have guessed Oakland, and I guess I say that because they put a picture of Oakland on the paper. Mm-hmm. But Oakland's not on the list?
No.
So it's not top five or bottom five?
No.
Okay. So we'll give that person their choice of either the Mix It Up gift certificate or some Jim Boy's tacos. Either way, we'll leave open the number one, and go ahead and give us the percentage of the number one stadium.
Number one was 107.4.
Oh. So 107% of capacity, which means 7% of the people are standing or serving beer, one of the two. So which football team is that? And they have had their fair share of news this year. 339-1140, 1-800-920-1140. Let's get on some phone calls here. Let's get to Mark. Mark, welcome to Talkin Money. How you doing?
Good. How you doing, Jeff?
Good. What's happening?
Hey, I got a question for you. I have a friend that's doing an FHA Streamline Refi, but they also have one of the TDAP seconds, silent seconds.
Yes.
My question is, and I can't wrap my brain around this, the rationale of it. It almost didn't get approved as subordination of the second because Cal FHA wanted to see a hardship.
Yep. And I
don't get that when all they're doing is lowering their interest rate and saving $350 a month.
It is asinine. In fact, it is so ridiculous.
It is.
That I had a client of mine who was doing the same thing. We got him all approved, ready to go, and he was going to save a couple $250 a month, and he had a CHDAP second, and CHDAP declined him because he was not a hardship case, because he didn't have a decline in his income. He wasn't about ready to lose his house, and I went round and round with CHDAP. I went to the point where I told the client they should either call it the local TV station or a reporter and figure out what the hell's going on. This is ridiculous. And CHDAP sent me their paperwork, and really it's not CHDAP, it's not the agency CHDAP. The
Cal FHA,
yeah, Cal FHA. They're following a guideline written by the senator, someone under the big White House there in Sacramento, that wrote their own rules, and their rules were very explicit to say, you have to be on the verge of foreclosure or show some decline. If you're just going along willy-nilly and you're doing just fine, they don't want to help you get a $250 savings. It doesn't make any sense. There's no logic.
Wrap my brain around that.
Well, wrap your brain around this. Have you seen anything come out of the legislature or the Senate in California that makes any sense? And then start with that and work your way backwards, because the answer to that is no. And then anytime you come up with another answer, the answer is still no. So we're talking about people who don't know squat about squat when it comes to the mortgage business, writing mortgage rules. And so you're right, Mark. It is ridiculous. It is ridiculous, and it's keeping people from experiencing some very well-needed savings. I don't know how you get around it unless someone gets a hold of somebody who's their representative and tries to get them to modify that rule a little bit. And it's like pushing a rock uphill. So.
Wow.
Yeah, Mark, hold on. Hold on a second. That's a good question. We'll give Mark some Jim Boys there on line one. Let's go to Dave. David, welcome to Talkin Money. How you doing?
Hey, Jeff. How's it going?
Good. What's happening?
Hey, I'm with my bank wants to give me a loan mod on existing loan, and my primary house, I have about 5 years left. They want to offer me 2.5%. Just want to see if you think it's a good opportunity for me to take to jump on it.
Okay, so they're gonna offer you a loan modification or a refinance.
A loan mod.
So what does that mean to you? They're going to lower the balance, or they're going to change the term and the rate?
Just change the term and the rate.
Okay, and
I got about 5 years left to go. I got 65 more payments to go. So
how much do you?
A little over a year.
Okay.
Over 5 years.
How much do you owe?
76.
And what's your rate now?
5.35.
Okay. I wouldn't do it only from the standpoint, first of all, and what's the place worth?
Probably about 275 to the low threes.
So why would they offer you a loan modification when you have 5 years left on your loan and you've got all kinds of equity?
That's my question.
Who's the lender?
Chase?
Something doesn't sound right. First off, I wouldn't do it for a couple reasons. If it's a true loan mod, then it will hit your credit as a consumer modification of your terms, and that can be a derogatory on your credit if you're trying to do something else. So I wouldn't. So from that, if you only owe $70,000 and you're going to drop, say, 2.5 or 3% on a $70,000 mortgage, it's not going to be a huge savings. You don't need it. And did they call you or did you call them?
They called me.
Yeah, that is so weird. Why? So you must not have a Fannie or Freddie loan, and it must be one that it must have just popped up on one of their lists of, these are the loans that we will try to do something with. I wouldn't do it. I mean, if they're really offering you a modification, and the reason I say it is I had a couple other clients that were just like you, who were upside down or close to it, and who were approached by Chase. They didn't call the borrower, and they were not made aware that the Chase was going to report, and I'm not sure if it's just unique to Chase or anybody. They were going to report it as a true modification, and it says on the credit report, modification offered to customer, some verbiage like that. And that means that in the real world, technically, you have to wait 3 years after a modification. It's treated similar to a short sale or a foreclosure. You have to wait 3 years to do some other real estate financing. So if that's the case, I wouldn't do it.
Okay.
I wouldn't do it.
Yeah, I was also thinking that the amortization of the loan, now the interest that I'm paying is so low.
Yeah.
At this stage, that
and
if I jump into a new loan, they're gonna, first of all, they want to put me into a 10-year package.
Yeah. So I wonder if they're just calling it a modification. Really, they're just going to refinance you. But I mean, why go back to 10 years from 5? I wouldn't do it. I guess if it were me, I don't think the benefit outweighs some potential of the risk, on top of the fact of just reamortizing your loan over an extra 5 years, which doesn't sound like you need to do.
Yep, that's what I was thinking. So.
Okay. All right, Dave.
All right, thanks a lot. Appreciate it.
Good luck to you. Thanks.
All right, thanks, man.
Yeah, I don't know. I don't get that.
It was probably just like, Chase goes through their portfolio and says, okay, we're going to go spit up a call sheet or a spreadsheet and we're going to kick mailers out or make phone calls to everybody.
Yeah, it could be. So and someone else had asked me probably 3 or 4 times this week, are we starting to see any of the, or what is the plan or the option for the non-Freddie, non-Fannie, non-FHA, non-VA, basically the true portfolio loans? What are the options for us? And the answer is there aren't any designated options yet. If you recall back a couple months ago, maybe 3 months ago now, there was a fairly large settlement in terms of cash and or other terms from some of these servicing banks that they paid up a bunch of money, but they were also supposed to designate funds toward targeting people that were upside down that did not have another option to get them out. But you know what happens, right? The press goes away. The entity, whoever sued the banks, gets their money. And they're like, oh, yeah, well, go do that. Go do that. There's no financial incentive for anybody to keep their thumb on them and say, get it done. So now there is a plan we'll discuss in the second hour here by Jeff Merkley, who's a senator out of Oregon, to help some of those people that do not have the Fannie Freddie stuff, which is a total slap in the face to the plan that his other cohorts are trying to do to get rid of Fannie and Freddie. So we'll talk about those after the break as well. So off the text line at 441140, did we get a winner yet for the we did? Okay, so we got a winner for the NFL team, the number one highest percentage. Their stadium is basically at 107% of capacity. How does the fire department let that get away? I mean, how does that get away?
Well, I think when you hear the city that it's in, you'll understand why.
Okay, so I would have guessed Green Bay, because I always hear that getting a ticket in Green Bay is almost impossible.
Not Green Bay.
But are they on the list?
No, they're not.
Green Bay's not on the top?
No.
You're lying to me.
No.
You can't read.
I know.
Okay, so who is? Give me your top. Go 5 to 1.
5 to 1. So number 5 at 101% is Chicago.
Chicago.
At number 4 at 102.1 are the Indianapolis Colts.
Okay, that makes sense.
Number 3 at 102.3 is the city of brotherly love,
Yeah.
Philadelphia.
Okay.
And at number 2 at 106.9, Big D, Dallas.
Oh, and that's a big building to fill.
That is a very big building.
That's a lot of people's.
That is a very big building.
Okay.
And at number 1, the Big Easy, New Orleans.
So New Orleans was the number one winner.
107.4%.
Real quick, who are the worst 5? I thought the Raiders would be on there, but they're not on the.
Oh, I thought, and I'm a huge Raider fan. I thought they'd be at least number 1, but they're not.
Okay.
Anyway, so bottom 5, St. Louis at 85.4. Is that still called TWA Arena?
I don't know.
Anyway, Buffalo, the Bills, 84.8. The Washington Redskins at 83.9.
See, that's the one that surprises me because I thought that they were. No, that's another big stadium, though.
FedEx Field, yeah. It's
Yes.
capacity is about $90,000.
Okay.
You got to assume that the Beltway boys would be able to.
Yeah, the ticket prices are outrageous, I hear, but go ahead.
Miami at 81%. And then bottom of the list is Cincinnati Bengals at 75.2.
Okay, there you go.
So there you go.
Cincinnati was your loser, and New Orleans was your winner.
Correct.
So that means we'll give out some Gym Boys to those people who got that right if they want that, or the Mix It Up gift certificate. Text lines are open if you want to jump in during the break, 441140. I will get to a few of these. My wife and I have been beat out of 4 homes because we had to go half on the closing costs due to our low down payment. I'll talk about that when we come back. I got a nice 8-track, Jeff, if you want. Give me a call. I actually might do that.
Casey and the Sunshine Band, I hope, somebody.
I think you can use the machine, but if you're going to sell me the 8-track machine, you got to sell me some tunes, dude. I can't find.
Exactly.
I need a whole box of tunes. I'm not going to say that. 339-1140, 1-800-920-1140. You can text us at 441140. Second hour of Talkin Money is coming right up, so hold on to yourself. We'll be
right back.